Good morning, ladies and gentlemen. Welcome to today's meeting. Today is the first of 5 talks on the history of business. Specifically today we're going to be looking at double entry bookkeeping. Now double entry bookkeeping is kind of a mystery when it first started out. No one is sure just where the concept originated. No one's certain who first introduced it. But we do know that it seemed to first appear in the Mediterranean around the 1st century. The concept was actually so successful that the Romans adopted it in their trading practices. And with the wealth of Rome on the march over land and sea coming into Rome, they were desperate for an accurate means of accounting. As a matter of fact, it's first mentioned as a process, as a concept, in 77 AD by a gentleman named Pliny the Elder, who was compiling an encyclopedia and actually mentioned the fact that the seafarers were using this process. It wasn't until, though, the 15th century that somebody actually codified it, so that everyone was playing by the same rules. It was all in black and white. There were no misunderstandings. And the people who brought this to us, well, 15th century Mediterranean trading, anybody who was anybody lived in Venice. They were the king of the 10%ers. They were the middlemen. They offered financial instruments like marine insurance, cargo insurance, leverage lending, brokerage fees, and pretty much any kind of deal you wanted to make, they came up with. So these people needed a mutual agreeable way of keeping track of the books, so that if products shipped to Britain, they would be using the same accounting method. If products shipped to Crete, it would be the same accounting method. And who codifies it? Well, of course, a Venetian. A Venetian monk, Franciscan monk, and mathematician named Luca Piccoli, who wrote it down in 1494. And this gentleman is now considered to be the author of accounting, the father of accounting, I beg your pardon. The need for double entry bookkeeping had been around for some time, but what they used prior to this was pretty much single entry bookkeeping, like a checkbook. An entry is made. As things occur, they're subtracted or added to it, but you have one column, and the accounts are listed there. Single entry accounting. The process with double entry accounting, you end up using a credit and a debit. Every single transaction is recorded in 2 places, double entry. Before the use of double entry bookkeeping and the single entry method, they used things like rope, tying knots in a rope, slip of paper, marks on a board. The Egyptians actually used 2 scribes sometimes, and then they would combine their results at the end as an audit. By the way, the term audit was actually coined in the 5th century by a Venetian, of course. Very popular then, very popular. But to eliminate confusion, and especially when you have multiple products involved, multiple commodities aboard a ship, wheat, rice, grain, wine, tin, gold. All of these separate commodities tended to get a little bit confusing with single entry bookkeeping. The mechanics of double entry bookkeeping are very simple. 2 entries. Every single transaction, 2 entries. So please open your books and look at your worksheets, and you'll see a ledger in there, or a facsimile of a ledger. Basically, you have something like that up here. Now, there's no need to get sweaty palms about this. This is really more of an inventory. You're inventorying numbers. It's basically all it is. On the left side, write the word credit. On the right side, write the word debt. And again, remember, this is all going to have to balance out in the end. Can anybody tell me what a debt is? That's right, it's an expense. Very good, an expense. And a credit? Exactly, income. Income would be a credit. Fortunately, we had that written right up on the board. Credit, income, debt, expenses. Now, as each entry is occurring, let's see what happens to it. Let's say our boat comes in and we have 100 bushels of wheat. That's BW, bushels of wheat. And we're going to offload that bushels of wheat. And it's going to have to go different places. We're going to say that 50 bushels of wheat are going to go to the government. Taxes. that expense we were talking about. 25 bushels of wheat go to the shipper as a cost for shipping things. And 25 bushels of wheat go to a wholesaler to be sold out to the country. The end result, 100 bushels of wheat, as compared to the 100 bushels of wheat we had to begin with. 100 equals 0. It balances out. Double entry bookkeeping allows you to make an entry here and account for the entry here. If you took a savings situation, let's say that you got paid. You got paid $100. Here it is. Income. And you take 100 of those dollars and you put 50 in the bank. You take 25, pay the phone bill. And you take 25 and pay the power. $50, 25, what do you got? 100. Total them both out, you come to 0. You've accounted for all of the $100. And the process can be used pretty much in any circumstance. Whether you're doing your bookkeeping, whether you're doing warehousing, anywhere where you need to account for the money coming in or the product coming in or the items coming in, and then where does it go? How do you account for it? Whether you're putting it from your income into payments or bushels of wheat into distribution. The double entry system will allow you to see immediately if there's a problem, if there's something not accounted for. That ends today's lecture. If you have any questions, I'll be here for just a few minutes. Thank you very much for your attention.